All right, thank you everyone for coming out here today. I appreciate it. Thank you for Riskmatics for inviting me to come speak at this event to all of you fine people. I was a little nervous when Alan asked me to come speak at this because I asked him, did I have to present in Spanish? And my Spanish is pretty limited as it comes from the football or soccer fields of Chicago on the lakefront playing every weekend, and the players on my team are all Mexican, and the language and Spanish that they teach me is not appropriate for a risk conference, I would say, or anywhere. But so Alan asked me to speak on this topic: how to hedge fund structure and development, and what it takes to create a great hedge fund. So while you're thinking about what a great hedge fund is, everyone has a different opinion and view on what makes a great hedge fund. And I thought I would give my background and my past because that builds for how I view it and for how we view it and for what we are looking for when we're talking about a hedge fund, okay? So given that, I'll give you a little bit of my background and then bring it all full circle at the end, all right? So my history, my background, goes back to when I was a very young age, right? I was probably 10, 11 years old, looking at the newspapers, reading the sports section and the finance section, but not reading the words, reading the numbers and following the flow of it. So I knew I was going to be involved with the markets at a very young age. And when it came time to go to university, I took all classes and studied geared towards commodities, specifically agricultural commodities, right? I took classes all on options and on cost of carry for corn, soybeans, all that kind of stuff. That's what I geared on, okay? And then when I went into summer looking for jobs and whatnot, I was 19 years old, and I got a job at the Mercantile Exchange, the CME, okay? And the Mercantile Exchange, well, you could see how many people there were over there. It was a massive pit. It was 1,500 traders were in the pit. And then around the outside, the yellows were the clerks. There were runners, trade checkers around the outside, and on the edges were the brokers. And it was the energy that you felt when you were in there. When non-farm payroll came out at 7:30, it was just electrifying. You could feel the energy build, right? And I loved it. I loved the energy. I loved that trading, okay? But it was also summer, so there were downtimes. And I used to sit there in the summer in the downtimes. I would sit there and paper trade, right? And I would paper trade and say, okay, here, buy here, sell here, da-da-da. But my boss, the head trader, would say to me, you know, you're not getting those fills. You know, you think you're getting those, but you're not getting those because it didn't trade all the way through that price. So I was adjusting my strategy and whatnot. But upon the summer ending, he offered me a job. He said, hey, I'll pay you $50,000 to leave school and come trade. I'm like, oh, hell yeah, that's awesome. My parents didn't think it was awesome. Came home, they said, no chance, you got to go back and finish school. So I did. I went back to university, just concentrated, making sure I can graduate as fast as I can so I could get to be trading as soon as possible. And I went, and this is the late 90s, it was the dot-com era. So it was when E-Trade, Ameritrade, all those were coming onto the market. And I would go, and I would, in between classes and studying, I would be trading. Right? I'd focus on 4, 5, 6 names and concentrate on those day trading amounts. I didn't have much money to deal with at that time. I'm a college student, but I was just day trading those, okay? And upon graduation, I was actually able to pay for all of school by my day trading. So I was looking for a job then, and it's the late 90s still, so I'm looking for a job. I had offers from the CBOE to be on the floor, market maker on the options pit, CME to be a trader down there. But what you can't tell in these pictures, these dudes are huge, all right? And it was more, my background was soccer, not rugby. And these guys would get in there, and you had to be really physical. And so I knew that what was coming with the electronic markets coming, right? And so with those electronic markets coming, I knew I wanted to be on the screens. And there were the CME the CBOT, the Chicago exchanges weren't electronic yet. They weren't there. So what I did then was I found a company which was trading Eurex, the European exchange. The European exchange, Eurex, was the first exchange that was electronic. They were the first ones there, all right? So I got the job, and I had to pass the Eurex exam, which was coming from graduating and studying options and futures. It was very simple. I was trading within a month of graduation. And they wanted me to start on the product called the DAX, which is the German future, the futures on the DAX, which is the German index of the 30 biggest companies in Germany. And I was like, okay, but I kind of like this other product that's over here. And it was a new startup product called the Euro stocks at that time. It was only trading a couple hundred contracts a day. And so I got in there and I started scalping it, right? Meaning day trading. Going back to the 3 different ways I've done it, it was just those intraday trades. That was the style of trader that I was, okay? And so as I'm looking at that Euro stocks, I was creating more and more volume, right? And I was, within my first year, I was 5-10% of the volume on any given day. And I was training people. I was teaching them. We started a room with just 6 people. I ended up training 50 people within the first year. But with more size and trading volume and everything comes technological problems. Technology is extremely important in our game, right? And that technology, there was something called a coffee cup. And what a coffee cup was when you tried to click on a trade, you got a coffee cup whether or not whether or not you got a fill. All right? So sometimes that would take 10, 30 seconds, sometimes a minute. And I realized that that was not acceptable for what I was trying to do. So what I ended up doing then was moving to Frankfurt, Germany, okay, to get closer to the servers, right? I needed to be closer. Technology was important. I needed to be closer to the servers. And Frankfurt, Germany, this is 2000, 2001, it was lively. It was like that euro-dollar option pit, like the euro-dollar pit. It was lively. There was traders went over to London to trade Euribor. A lot of them started coming back to Frankfurt in that early 2000s because that's where the whole community was. So the community was there. There were people going out after work, and the trading community, everyone knew each other and really talked. It was lively. It was important. It's a part of an important ecosystem, right? Is to have that base of people like you guys are doing here today and having those events, okay? And so I was trading it for consistently in Europe, but then there were 2 things that happened. 1, 9/11 happened, and 2, I saw what German taxes are. And I'm like, I got to get back to the U.S. All right, so regulation got in the way a little bit of my building more of a business there. So I came back to the U.S., okay, and I started my own company. But then I did everything, right? I was a trader, I was a trainer, I was a risk manager, I was IT, I was accounting, everything. I did it all, right? But it taught me a lot during that time. And that's when I really put my head down and focused on the product. I focused on it and studied it. I woke up an hour before, which is 1 a.m. I woke up that time to focus on the market and see what was happening that day and see what was moving the markets and all the different products in there. And through that time, I went then 3.5 years consecutively of making money every day. And it was just grinding. It was a mental focus to be positive no matter what. So when on a day where I was down, I started the day down, whatever it is, okay? I wouldn't trade bigger and try to get it back. I would trade smaller and grind it back and grind it back and just stick with what worked, stick with what got you into that streak, okay? So that type of mentality of finishing every day positive, putting together good runs, not having drawdowns, that's a key component. That's stuff that we look for, right? So time was going by, and during the same time, little side note away from trading, which this will come back later, I was investing in private equity, and I was getting 4, 5, 6 times returns on my investments. So I'm like, oh, okay. I talked to some friends and family, like, hey, let's put a couple $1 million into a fund. Let's create a fund. But the problem was, this was 2007. So I spent a lot of money setting up a fund in 2007 for private equity. We all know what happened in 2008. Not the best time to have a private equity fund. All right, but I didn't care that much because trading was great still. Okay, so continued to trade, and then what happened in 2011 was Eurex, the exchange, changed the game a little bit. They created two different markets. They had not two different markets, but two different ways to access the market. So again, coming back to technology, they had a 1 gig line, and they had a 10 gig line. All right, the 10 gig line was catered towards HFT. Right? So HFT trading was getting a special treatment. I wasn't HFT at that time. I was a click trader still at that time. I had good technology, I had some algos running, but I wasn't HFT. Those were sitting on my computer. All right? And so what happened then was, as your order was going in, you could visually see that you were being bested in the market. And I talked to the Eurex, and they wouldn't make those changes. Right? They were catering strictly to one part of the community, not all the others, not the click traders, not the others. And so that's when I decided, okay, I have 10, 15 traders. I gotta look at adapting here. And that's when I met my current business partner, Amnon. He was a trader on the floor of the TMX, and he had his own trading firm as well. He had his own all click trading at that time, but it was all on the Montreal exchange. So the two of us talked, and we really saw eye to eye on business, and we decided to merge that's when we created ARB Trading Group. All right, we merged our two companies and created that entity. And we both stepped back from trading and concentrated on finding talent. We had an email inquiry from a trader in India at that time, and we were like, what? How does this trader in India know anything about European markets? And so we went on a world tour. We started in London, Switzerland, went to 6 cities in Germany, Poland, India, and we saw where there was talent. We were looking for talent, wherever that talent may be, whatever they were trading. All right? And we went to India, and in 3 days that we were there, we rented a small little conference room. We had over 100 traders go through. And very similar to the feeling in the pit, with the excitement, the feeling in Frankfurt, Germany in the early 2000s, that was India, right? You could feel the excitement brewing there about trading. They didn't have exposure to the global markets, really, all right? These were all domestic traders. So we ended up setting up an office then in India, and we continued to grow and expand the business. But we knew the most important part of having a proprietary trading firm is risk. We have to have risk. You got to have the technology for risk. You got to have the risk team in place. You got to be able to analyze what every trader is doing at every moment. All right? So we grew the risk team as the base, which we took, our risk team's like 10 people right now, but we took people that were traders with me in Germany, right, in the US, and we added them to the risk team. We took options traders that knew how to look at markets, right? So we created that risk team, and then we went out and continued to find traders all over the globe in whatever they would trade, right? Right now we trade 30, 40 different exchanges. We market make on those exchanges. We have traders that use microwaves, and we have click traders. We have the whole spectrum of trading, right? All the way down, right? But a key component is we don't have anyone that is too large, right, in the trading. We got to make sure that those traders don't go beyond a certain amount, all right? Our number in the prop trading, it sometimes is 10, sometimes is 20, maybe 30, but that's kind of the range that we will not go beyond, right? So one of the problems then, when you have that type of traders, right, that can keep going and scaling, is you need to roll them into funds. You need to get them off of the prop trading book and get outside money. Because prop trading, you can't get outside money into a prop trading firm. right? It's against all rules. So we started looking to scale out and create ARB Asset Management then, okay? So ARB Asset Management is our arm of the strategies, the internal strategies that we're rolling out into hedge funds, all right? So going back now, I had a bad experience 2007 having my own hedge fund, right? It was started with a couple $1 million. The costs were accruing. The value went down 50% in the first year, and the cost stayed the same. So I knew all this, but I was looking for the right cost structure then for us. And we came across a company called 4Alts that had just spun out of HFR, a platform for fund management. And the CEO gave me this pitch, and I wanted to read it so that I got it right with what he said here exactly to me. So he said, we structure institutional quality hedge funds for managers, allocators quickly, effectively, and cost efficiently. We create the entities, all the offering docs, and coordinate and contract with auditors, administrators, legal, trading counterparties, and investors. Essentially, we cover all operational regulatory matters related to your fund, leaving you what you do best, trade. Okay, I was sold on this, right? I'm like, this is great. This is exactly what we need. They're able to do all this legwork. They're able to handle all that for us without me having to do all that administrative work also, right? So now ARB can be our internal scalable prop strategies, okay? We could bring those to the market in SMA structure, which I'll get into SMAs a little bit, and fund format in a way that utilizes the scale, the architecture, the technology, our risk management, and the knowledge of the proprietary trading business. It puts ARB at the intersection of prop trading and asset management, which I think is a rare combination. So we just began this asset management journey, okay? But how we develop it, how we want to grow it, is the same way that we did the prop firm, with traders trading every different kind of style, every different market, all right, to create a multi-strat, okay, multiple strategies within the hedge fund, right? That's our ultimate goal, is to create that, replicate that, okay? So that's how we look at things. That's how we view things, and that's what we're looking for. Now, there's going to be individual hedge funds for strategies, right? Individual strategies are their own hedge funds also, okay? But let's see. Oh, man, it's wider. All right. So the wrap-up of the history. The opportunities in niche markets, okay? That's what we're looking for, right? There's opportunities. I saw an opportunity in the Euro stocks, right? There's opportunities in the Mexican markets, in Brazil, wherever, right? There's opportunities. Find those opportunities and technological advantages. Sometimes there are technological advantages. I happen to be that 1 gig scenario. There's the 10 gig, right? If you can get in that, if you have that technological advantage, great. That's awesome. That's something to look for. The right ecosystem for trading environment. You got to make sure that the regulatory bodies don't get in the way, right? I know that's something that's been a big topic here, and it sounds like things are moving in the right direction, which is partly why I'm here, right? Consistency is the key. I don't want to see those big swings, nice and consistent. That's what I'm looking for. That's what we're looking for. It's tough to be small. Don't be afraid to team up. Don't be afraid to have those, to merge with someone else, right? Don't be afraid to partner up, to give a little piece of your business to someone who's really going to help you. Talent and opportunities can be anywhere, right? We found it all over the globe. I think we have traders from like over 35 different countries. They're everywhere, right? Look for them. A diversified portfolio, limited exposure to risk, not one group, right? You can't have one trade ever bring you down. You can't have that one outsized trade. Everything has to be in line, okay? Well, that goes to the next one too. And tough to have a hedge fund with too small of an investment, right? So that was my experience. right? I had too small of an investment in there, and it started eating at the costs, okay? So now we get to the question of, should I start up a hedge fund? All right, that's the first question, is my strategy profitable? If the answer is no, you may think this is an obvious answer, but if it's no, don't start it, right? Like, I can't tell you how many traders have come to me and said, oh, if I just had more capital in here, if I had just had more AUM, I would be able to do it. Maybe 1% of the time that's the case, all right? Is it better than existing alternatives? This is pretty obvious, I think, too. You compare it to the market. If you have a long U.S. equity strategy, how does it do compared to SPY, right? It's very easy for an investor just to go buy SPY, all right? Is my strategy something people want, need? You know, do I have a long, short strategy on the Mexican markets? Right? That might fit into great into a global macro. That's something that we want. That's something we would look for, okay? Do I have a large seed investment? I'm going to come back to this one a couple times. Do I have a large seed investment? Are you the one seeding it, right? Getting that money in the door is very important. You can't get anywhere without it, okay? Okay, now there's 3 different types of funds. So now you know, okay, I'm ready to start. I have these things. I'm ready to take my next steps and go. Okay, what kind of fund am I? Am I an automated fund? Okay, automated. No human interaction at all. The number one thing that everyone's looking at in that regard then is those back-tested results or live results, right? You need to look back. I gave the example of me paper trading those Eurodollar, right? Back in the 90s. Backtesting's the same thing. All right, if I see an options trader come to me and say, hey, I have backtested results, I'm going to be very suspicious of it because options are pretty wide and all it takes is to trade one. You're never going to get that fill. So to have a backtested results is extremely important, and the data is important. The data within there is important. So again, technology, data, looking, analyzing at it is very important. The background of the programmer. All right, what is the pedigree? Where did they come from? Right, that's who it really matters in this scenario. How did they calculate the data? Right, were they at a Balyasny? Where were they? Right, where did they come from? Was their strategy profitable before? Okay, discretionary. That is, like I was, a trader. That means it's human. It's all human. So really, it's tough to look at. There's no back tested for traders if it's a discretionary strategy. It's all, what have they done? What have their results been? How have they done over time? That's what matters, all right? Then there's the hybrid. That's a combination of both. That's the most difficult to vet because now you need to go both routes. You need to do all the back testing results and check them, and you need to check the background of that actual trader, all right? And everyone likes it a little differently, right? Like I talk to and deal a lot with the discretionary and hybrid traders. My partner deals well with the automated traders. So everyone looks at it a little differently. Everyone's a little better at it, but you need to know what you are before you go any further, okay? And then the timeline here, the timeline for setting up a hedge fund, okay? So you need to compile that data. Getting all your, whether it's live or back tested, you need to get that all organized and audited sometimes, right? Some investors will ask for that to be audited, and you need to go back and collect that and get those results in. Because if you come with just an idea, that isn't going to get very far, right? You need to have the data. Build a deck and tear sheets, okay? The tear sheet, the deck, that is what the first thing that I'm going to see. Right? I'm not going to, I get hundreds of these a year, right? So sometimes you only get one chance to make a first impression. And I'll look at it, and if it's too complicated, not clear, not concise, I'll just say, okay, this is too much noise going on. You want it clear, you want your results on the front page, and you want to be able to give that out to your investor base right away. Secure seed investor. We went over that once, probably going to go over it again too. Having that person, there's no point in going further unless you have that, all right? Determine compliance needs. That's the big topic here, and that will be a different concern for you guys than it is, let's say, for one of our traders in Chicago, all right? But the compliance needs are very important. Are you gonna, in the US, are you gonna be a 3C1? Are you gonna be a 3C7? Like, who's your investor base? Who are you targeting? What is that gonna look like? And that's how you gotta decide that structure. Fund launch and initial cap raise, that's just ongoing. That is, the last two, those are just constant. You're always doing that. It's always trying to find people because investors always leave too, okay? So now the cost of setting up a fund. The most expensive one, hands down, on the initial structure setup is the legal, right? You're looking at anywhere from 50 to 100 grand, maybe more. In our structure, we can do it a lot cheaper for you, but that is the legal amount that you're looking at. It's subscription documents. It's all the operating agreements, all of that stuff. You got to get all of that legal together, and those lawyers are putting their name on it, so therefore it's more expensive. It's a regulated entity that you're creating, right? The audit, every year, you have to do it. It's $11K there for the US, $30K for US onshore, offshore. We use Cayman. Cayman's our main infrastructure. That's what we use, which leads to FATCA, which is basically just a regulatory fee for US investors. But you have to have that even if you're in Cayman. So even if you have one US investor, you're subject to that FATCA. Banking, tax are obvious. There's one that I left off too, which is administrator. Every fund needs an administrator. Those administrator, I left it off because if you're just starting a fund, it's not that expensive. But as you get scale, that number stays the same. So usually it's, let's just say 10 basis points, right? So a $10 million fund, it's 10 grand a year. But if you have a $1 billion fund, it starts to get somewhere. But, so that's the administrator. Now, these are all important because these fees are here no matter what size your fund is. And that's where I go back to that fund I had in 2007. I had all these costs I had to deal with, right? And it creates a drag, right? So if you have a return going of 10% on a fund and it's only 2 million, that return is now closer to 5%. Right, so you got to think about that as you're going through it. The number one question before you start the process, I think I've gone through this a couple times already, but it's, do I have enough money to get off the ground? Okay, and Tom threw a little Tom Cruise in there, but you have to have it. You're not going to get anywhere unless you have that seed capital if you have the money, okay? It's the most important thing. Okay, so now you want to look at who are your target investors. Right? Who are those? Who's going to invest in your fund? High net worth individuals, family, and friends are always great. Those are always who you should go to first. But then family offices. I heard there's, I think, 50 to 100 family offices in Mexico. That's a great place to start. And I'll get more into how the family offices invest, but they are always looking to. They're looking at opportunities similar to a prop firm, okay? And as you see there, 4 to 7% is all they're invested in hedge funds, and those include long-short equity and equity, long equity. So they're underinvested in alternatives, right? In derivatives, they're underinvested in them. So that's a real opportunity, and that's where most of our focus is, right? Wirehouses, bank platforms, and institution pensions can kind of go together. They're both down the line. You're not going to get. You're starting a hedge fund. You're never going to get there with those type of investors. That takes time and effort, but it's reaching out to them, letting them know that you're there, sending them your reports and whatnot. Registered investment advisors, and a surprise for many of you as an investor, okay? This goes with the family offices too. Prop trading firms, right? We do tons of investing in startup CTAs and funds, right? But we don't do it how you think we do. We do it in SMAs, separately managed accounts. So what that is, okay, for those of you that don't know, what that is it's on my books, right? So you have all of our main accounts here, and underneath it, you have a sub-account for that fund, right? We'll write checks starting at $1 million and working our way up, okay, for that. And it's a great place to get off the ground, right? But what we're looking at in that capacity is the margin to equity ratio, right? We want those margin to equity ratios 10, 20%-ish, right? So if you're getting a $1 million allocation, that means your average usage is around 200K maybe, right? And because in the prop firm, we're able to offset that against all the other investments that we have in the portfolio, all right? So that's not to be understated, the proprietary trading firm. That's also how family offices deal with it too, right? A lot of family offices have that structure and bring it into that structure as well, all right? What are investors seeking? Okay, results, track record. We're always looking at all of them, right? Looking for that peak to trough. What was that peak to trough? And when that peak to trough happened, what happened to margin during that peak to trough? If you drew down 20%, did margin go down, or did it go up at that time, I should say? Now, would that leave your base? Do you have any powder left to trade? Like, did they have to lower their size and not be able to recover after that? That's what you're looking for from the track record. Drawdowns, I just went into metric, Sharp, Sortino. Those are every single allocator there is will ask, what's your Sharp, what's your Sortino? Those numbers are how you compare your fund to other funds. But you're not comparing. You're comparing like funds, right? I'm not going to compare a natural gas fund to an equity strategy, right? I would compare the Sharp and Sortino of a nat gas to another nat gas, all right? Margin usage, talked about it. Skin in the game. Does the manager have money in there, right? Does he have his money or his friends and family's money invested in the fund, right? Some allocators won't even look at it unless it is. It's a key component for us. It's not a 100% a no if it's not, but it is a very large variable. And the manager, right? I mean, who is that manager? What's his track record? What is his pedigree? All of that matters too. And going through the manager, right? I go through it, and when I'm looking at it, looking at the results, looking back at different time periods of history and what that fund did during that time. So if it's 2000, if the fund goes back that far, 2000, 2001, the .com, how did it handle the up and the down, all right? 2008, the financial crisis. What happened during that time, right? How did they handle each of those markets when Lehman went under, when TARP came out? What happened during those times, if they were trading then, right? The 2011, the debt crisis, Portugal, Italy, Greece, Spain. If you were trading any equity markets, how did they look at during those times? Or fixed income, right? The 10-years were all blowing up at that time in each of those countries. January 2015, Switzerland dropped their debt ceiling, all right, or their currency, the floor, and instantly. So if you're trading FX, what happened? Because all currencies got spiked at that time. They all did crazy moves. So how did you do in January of 2015? In China, devaluation, that was August of 2015. If you traded any indexes, Asian indexes during that time, how did they do, right? So no matter what you're trading, I can go back to a period in time and look at it. June 2016, Brexit, right? Anyone trading European markets, looking at June of 2016, and then the election, the U.S. election, November, right? The Republicans took all three. How were you positioned during November of 2016? COVID, obviously, everything. You can analyze everything in that March, April. How did they recover? How did they trade during that time? If an energy trader comes to us, I'm for sure looking at March, April, May of 2020. How did they do with the inverted prices, negative pricing? Equities, there's a lot of equity strategies, right? So in 21, everyone can make money. I see all the results. Everyone made money in 21. Did you outperform? How'd you do? In 22, how much did you lose? And if you didn't lose in 22, then you're great, okay? If you're in that. Grains 22 also when Russia invaded, right? It invaded Ukraine. All the wheat pricing went crazy. How did you do during February, March of 22, right? So, and rates. Yeah, we see what rates are doing now. I'm obviously looking at anyone trading rates in the last 2 years, month by month, looking at it and seeing if they're consistent in the results. So you could take, no matter what a trader trades, or portfolio manager, whatever they're trading, we can look back at history and see how they did and compare it, right, to everyone else. Okay, so one thing I thought would be important to explain was the payout system, right? Everyone's probably heard of the 2 and 20, but those are few and far between. And at the beginning, you're going to be closer to a 1 and 10, 0 and 30, or 0 and 0, all right? And so the first number, right, is the annual fee that the investor is paying to the manager. And the second one, the 10, 20, is the incentive fee, so that if you make money, that's what you're getting paid out on. But when you're starting a fund, you need money. You have to adapt, right? And some, I know of one in particular, family office, that gives 0 and 0 deals. 0 and 0. You might be saying, why the heck would you do a 0 and 0? It's because you need AUM. You need AUM to get to the next level, okay? We don't do that. We don't believe that you should hold people to that. But we do 0 and 20 and 0 and 30. That's typically what we do. We don't like paying out on the annual fee component, but if you make money, we'll pay you, right? So just to go through numbers real quick so you kind of understand that. Like a $10 million fund, okay, that's at 0 and, let's say, 10, okay? $10 million fund, 0 and 10, that produces 10% returns, okay? That means they made $1 million, their investor made $1 million, but that investor has to give 10% to them. So that $10 million fund, you only made $100,000, right? And you still got to pay your employees and your costs, your office, all those other things, right? So getting to certain levels of capital, of AUM, is key, right? And you need money to get to the next level, okay? So now, we have all this, how to set up the hedge fund. You decided on the structure, right? Is it going to be U.S. only? Where are your investors? That's what you're looking at. Is it going to be U.S. only? Is it going to be Cayman? Is it going to be BVI? I know Mexico's working on it right now. Hopefully there becomes an industry in Mexico here with some regulation changes, legal documents you need, compliance we went through, audit, banking, clearing, accounting, administrative also. You need to get all those things structured, then you're ready to go, okay? Now, how to make that fund great. You're up and going, you're trading. How do you get that going? You find that competitive advantage, okay? That's the first thing. Marketing, trading information sources, isolate an advantage that you have, okay? And get that out there. Let people know that what your investors, what you're doing. Define your strategy. Be clear and concise. When you talk to an allocator, you can't fumble around. You have to be clear with him or her and be direct, okay? They have to understand what you're doing. They have to understand it. Avoid drawdowns early on. The beginning part is the most important. If you have that drawdown in that beginning, that's going to derail you instantly. And develop a marketing and sales strategy. Without sales, you're not going to get anywhere. So you've got to get out there. And that gets into like the next parts of what you could do, okay? So raising the capital. You create a mailing list, okay? You find out who's interested in your results and whatnot. You create a mailing list, check results monthly, maintain them up to date, compliant, make sure they're compliant always, and update that pitch deck. Investors, like I want to see right away, I want to see one of the first days of the month what the results of this fund were. I have tons and tons of funds sending him to me on the first couple days of the month, right? How did they do that month? I want to see it right away. Asset management conferences. they're all over, right? There's tons in Miami, all right? iConnections, MFA, there's a lot of them. And getting there and getting to an allocator, you never know when someone who you've talked to is going to come back to you and be an investor. So go to those things, communicate with those investors, send quarterly newsletters, and get into databases, right? There's a handful of databases, SACHA and HSBC. Get into those and get your funds on their databases, okay? Now, the milestones along the way. That beginning part is getting off the ground. That's the most difficult. That launch with 2 to 5 million-ish is kind of the target point, which is puts you kind of even still at a loss, right? You're going to be at a loss there until you probably get to that 10 million mark. But you got to start somewhere. So starting there, 10 million is a big point, but then 50 million is key, because 50 million is key and 100, but 50 is key because a lot of investors have to be 5%, they have to do at least 5 million, and they can't be more than 5 or 10%, right? So that puts the math at 50 and 100. That's why those numbers are key. And then obviously $1 billion, it becomes a lot easier then. The other thing is 3 years. 3 years is a key level. That first 3 years, the pensions, the wirehouses, they need 3 years of a live track record before they can show it on their platforms. All right? So that's all, that's the whole structure, basically, of setting up the hedge fund, okay? And, we have a lot of companies. We have ARB Asset Management, ARB Trading Group, ARB Fund Management. We have technology. We have all the things that can help you get there. So I just put this up here just so you guys all know all the different areas that we can help you with and make things easier, quicker, cheaper, and more effective, okay? I'm here. Please come up and talk to me. I'm open to any type of conversation. We can talk on any of the topics in terms of what we have to offer. Reach out here if you need to. I think that's good. I think we're going to do Q&A now. Thank you. That's it.